what did you want to chart out and show us with your wrinkly brain?
Okay, I guess I can go over the chart briefly. What I think it's gonna do. I think we'll do a double bottom today with a reversal. Volume will die down a little bit, and then we'll probably consolidate around the 152 level. And in the event, again, not to spread FUD, in the event there is a insider sell-off or some kind of large holding sell-off, what we'll see towards the end of the day is we'll see volume ramp back up, and we'll be testing the 140 level and the 132.8.5. I usually round it to 0.5. 132.5 level. I don't think that's going to happen because they would have done it here, if anything. So I think what's most likely is we'll consolidate around 152.5. Volume looks like it's dying down. We're going to have a pretty boring midday, I think. During power hour, you might get volume back up. And if people really think this is going to be like a true bottom, they might set up for a reversal play and we might get a rally at the end of the day. But my best bet is we're going to get a pretty boring day where volume basically dies back down to like 20,000 a minute or something.
In that sense, when are we? So by the end of this week, we've even heard the SEC regulator say from a February interview that she is expecting major things to happen in the end of the quarter. Do we expect volatility end of the quarter? Is that because we expect volume? And what can we think of coming up on this 26th? A lot of people had specific questions about, strike prices and stuff. We're not trying to be that specific, just in general in terms of momentum. Can we zoom out of this chart and see what we expect from maybe a 30-minute hourly chart?
Sure. So right now it's not really a downtrend. It's a really broken trend because of their short attack. So it's really messed up right now. My plan at least was to wait a few days, see what's going on so originally I drew this diagonal support. That's what we that's what we were on schedule for. It was bound to eventually give way when earnings came, and then something would change, and you either have a really high trajectory or you have an adjusted trajectory, something like this. I'm not going to draw it yet because we don't have enough data points. But
when did you draw that line?
Yeah, so the 172 is we followed this for months, like many weeks. This was from the initial run up. So this period, this segment over here is retail buying in, and retail was able to establish the rate of change of the price. So to measure the rate of change, you can connect the dips of the retail rally. And this tells us a sustainable floor run up. Of course, as the price goes higher, you'll be able to buy fewer and fewer shares. So eventually at some point, it usually starts off linear. So this is the 172 diagonal. It's called the 172 because it bounced 172 over here on this day during the short attack. So usually it starts off linear, but over time it'll start sagging a little bit like that. Because of the stock price being too high, retail wouldn't be able to keep up that rate of change. So you'll lose the buying momentum, and the support usually gives way. But I don't draw curve supports. I just say, okay, at some point it's going to break through the support because you lose the buying pressure. So that's the 172. Yeah.
So when we were on a different rate of return I think that was the end of February, beginning of March. What were you thinking? And that line that you drew, when were you expecting it to go back to the same rate of return?
So to clarify, are you talking about right now? Like when do I think?
I'm talking more about the steeper run up to 350.
This one.
Yeah.
This one. So I think what validated this rate line, this 172 line. What validated this was because of the pump and dump. You kind of have, so I think all of these were since shares getting traded back and forth, but to validate this is a line is usually validated if you have a pump and dump and that dump refuses to go below that line. So on this day, we saw it bounced quite sharply. It bounced really hard on that line. And then it overshot a little bit. And then it kind of returned to that line and followed it until earnings, when people realized that our positive catalysts can't keep this rate up. So that's usually what validates the, I'll call it like the baseline kind of.
So for those of us that are looking at your bounce analysis here, what is the mental psychology that goes behind how a chart bounces? And do you ascribe to the Elliott wave theory? How does that fit inside corrective pulses and impulse waves?
Sure. So first thing with bounces, if you have a lot of HFTs and you have a lot of retail, if they follow the same rules, then those rules are a self-fulfilling prophecy. If everybody believes that, let's say, the stock was going to follow some kind of trend line, they're going to anchor their trading strategy based on that belief. What that means is, if I think that it's going to follow this line and I wanted to buy stock, I could put a limit buy here. So the more people that learn these like TA strategies, the more that they follow these strategies, the more valid the strategies become. I think back before the 2000s, like 1900s, when all of these theories are first proposed, it wasn't really like a widely practiced thing. It was natural. Like, it was observed by, let's say, Elliott himself, right? Elliott and other people who wrote these books. It was observed by them. It held true naturally. But then people started adopting these strategies. And the more people that adopt, again, the more valid the strategies become. So these strategies started becoming like common things that every single technical trader would do. So what happens is you even have algorithms doing this. You have algorithms anchoring their buy points on support levels, and you have retail anchoring their buy points on the same support levels. So what happens is that support becomes invalid now because of the self-fulfilling prophecy. So I can say that people were anchoring all of their trading on this support up until earnings, basically, up until this point where it broke through the support.
Speaking of high frequency trading, let's just cover two tactics that we've read in DDs on our GME that I want to see your opinion on. Famously, Pixel was someone who did not believe, at the very least did not know enough about short ladder attacks. So I'm wondering what your opinion is on the validity and the presence of spoofing, layering, and conversions.
Sure. Do you want me to cover Elliott waves first?
Oh, sure.
We skip over that?
Sure, go ahead.
Yeah. So I do see a lot of people talking about Elliott waves. I'll show you an example of what an Elliott wave might look like. Let me go to this day. Is this a good one? Okay, this is okay. Elliott waves are naturally occurring patterns that Elliott observed, and then he wrote a book on, or published a paper on. I forgot which one. But you can see it right here. Here's a 1, 2, 3, 4, 5, 6, 7, 8 step Elliott wave. Mm-hmm. Prices move in waves, Elliott said. And they move in waves because people buy too much and then they have to correct that. So then it goes down. So it's kind of waves of buying and selling, buying and selling. So these are Elliott waves. Elliott waves are most applicable to natural price movements. The DD I see on Reddit, and I like that people put a lot of time into those DDs, but I think that the macro scale Elliott waves aren't valid because they don't apply to manipulated price movements. And by manipulated price movement, I would say this is manipulated. Not really manipulated, but it was a large institutional buy-in. It wasn't a gradual, natural buy-in by a group of diversified investors. It was just one investor, one or two large whales. So a lot of DDs I've seen is the Elliott wave that we're looking at is a 1, 2, 3, 4, 5, a 5-step Elliott wave, and that fifth leg of the wave would go to like $10,000. But I don't think it makes much sense to talk about Elliott waves at the macro scale because an institution could just as easily tank the price with another short attack if they wanted, maybe to this level, nothing extreme. But if they do tank the price, that automatically invalidates the Elliott wave, because now you have like something like this. It's like a downtrend and then another downtrend, but that's not how Elliott waves work. So that's why I say we shouldn't use Elliott waves here, because it could go any direction any second based on what the institutions want to do.